you how to do actually the closing stock. How do I want to stop the transcription? It's very annoying. Give me a few minutes, yeah. It's already recording. Okay. Can you see my slides now? Chapter 8, Inventories and Cost of Goods Sold.
Yes, doctor.
So what I'm trying is still under the same topic, but it's just that it goes more detail on how we are going to determine your cost of goods sold and your closing stock, yeah, closing inventories. So remember that just now we have actually looking at your inventory, which is your balance sheet item under asset. All right, and then when you make sales, then you are going to record that under your income statement, cost of goods sold. And this cost of goods sold is deducted against your sales or your revenue. Yeah, so you must know. So what is under inventory here, the balance sheet, is the closing stock, right? What is under income statement is the cost of the goods sold. So we are going to look into this chapter, how to determine your inventory values here in your balance sheet and how to determine your cost of goods sold in your income statement. In the previous chapter, we just mentioned is inventory, closing stock is how much, right? Your COGS is how much. But here you want to look at how do actually we determine the inventory values and your cost of goods sold. All right, the flow of inventory costs. Yeah, in a perpetual inventory system, inventory entries parallel the flow of costs. So remember that just now we look at when you purchase inventory, right? You debit your inventory, credit your accounts payable, and you make sales, you're going to debit your cost of goods sold and credit your inventory. And these are always at cost, right? You still remember this? These journal entries, when you purchase, under perpetual, when you purchase, you debit your inventory, credit your accounts payable. When you make sales, you debit your cost of goods sold and credit your inventory. Of course, you have another transaction or journal entries where you record your accounts receivable and your sales. Right? So which unit did we actually sell? So when identical units of inventory, so remember that when you make sales, you have so many types of inventory that you make sales, right? So just now example of the dealer, the motor vehicle, right? That's the dealer that sell motor vehicle. Of course, when you sell a motor vehicle, it is very specific which motor vehicle that you sell. Right, especially if talking about a second-hand motor vehicle shop, they could have different types of models, all right, different costs, selling price is different, so they have to identify very specific which motor vehicle is sold and what is the cost of the goods that they sold, right? So that's why we are going to look into this chapter. Right, so when there's a cost of goods sold, you have to identify how much is the goods, the cost of the goods, right? So what we do is that we are going to have a what we call inventory subsidiary ledger, right? So this ledger is to maintain item or each item in inventory, and this is normally being done if you have a high volume, a high sales value. Yeah, it's very expensive, so you're going to have a record of each of your inventory. All right, so for example here it shows you a subsidiary ledger where on January 5th you have 2 units and each one you purchase, each one costs you 1,000, so total purchase is 2,000, right? So as of that date, you have a balance. In this case, you have 2 units that cost you 1,000. So balance is 2,000. On February 5th, all right, you purchase another 3 units and each unit costs you 1,200. So total cost is 3,600. So as of January 5th, you already have 2 units that cost you 1,000 each. You have 3 units that cost you 1,200 each. So total units that you have is 5 units. But the total value of your inventory is 5,600. So are you following this table so far?
Yes,
Do you
Doctor.
understand the table? Okay,
Yes,
so
inshallah.
careful with your balance here. So you have 3 columns. One is for the
Question.
yes.
Sorry to interrupt you.
Yeah.
Why under the total on the balance they did not put like 3,600 as on the 5th of January? Why they don't do the same for the 5th of February under the total balance?
Okay, because on the 5th of February, you already have 2 types of inventory. You have 2 units that cost you 1,000 and the 3 units cost you 1,200 each. So you have to separate the units.
Oh, okay.
Yeah, you have to separate them. All right, then only you have a better. So you know that okay, your cost 5,006 comes from which units, right? The total of your closing. So it means that your balance here is your closing stock. So you have 3 columns. You purchase, how much you purchase, and how much you sold, and how much is the balance at any point of time. So under perpetual, remember that at any point of time you have a balance. All right, so you know that okay, I have 2 balance of 1,000 and 3 units of 1,200. Right, you have to show that individually. Okay, so you understand this table?
Yeah, now I understood. Yeah.
Right. Okay. So next is that it says that specific identification. So if on March 1st, Mead sells one of these alco generators. So where is this alco generator comes from? I'm not sure. Right. So to Boulder Construction for 1,800 cash and use specific identification, the company will have to be. So in this case, all right, it shows you that how is the recording of your purchases. For example, the first one you purchase on January 5th and February 5th, you have 5 generators. Right, so the balance as of January 5th is to have 2 units 1,000 and 3 units at 1,200. Right, but it says that if you use a specific identification, it means that when you make sales, it's clearly very specific. You identify which inventory that you sell. All right. So example just now, for example, in this case is generator. Right. You sell it for 1,800, but you must know that which unit that you actually sell. So the information provided is that the cost of goods sold for March 1st is 1,200. Right, so means that it's clearly specific that the goods that you sell is the one that costs you 1,200. So it means that if you have sold one unit that costs you 1,200, so it means that as of after the sales, the balance that you have is that you have 2 units at 1,000 and another 2 units at 1,200. What's the difference between February 5th and March 1st? The balances. Anyone? What's the difference now? On February 5th, all right, the unit cost of 1,200, you have 3 units. But you have sold one of that unit on March 1st. That's why balance now you only have 2 units at 1,200, but the cost of 1,000 you still have 2 units. Right? So in total you have a total balance of 4,400. Right, so in this case, right, just like when you sell a motor vehicle, you must be very specific which motor vehicle that you sell, because the price of each motor vehicle, especially for a second-hand car, right, the price is not the same, the cost is not the same. So it has to be very specific which one is actually you sell, so that you know at the end, all right, what is the balance of your inventory. Does that make sense?
Doctor, I have a question. Since we don't have units, in March. How come we have 4 units under the inventory balance?
You don't have units. On the February 5th, you have 2 units at 1,000.
Okay, and then
3 units at 1,200.
okay.
And then on March 1st, you sell 1 unit that costs you 1,200.
Oh, okay. So basically, it means that I did not sell any of the items. So my first sale was in March 1st.
Yes, yes.
Oh, okay, I got it now.
Right, so that's why on March 1st, the balance is only 2 and 2. 2 units that cost you 1,000 each, and another 2 units that cost you 1,200.
Okay.
Right, so this one is what we call specific identification. Right, so this method is especially used by companies that sell a unique item. Yeah, for example, you're talking about motor vehicle, you're talking about a boutique, right? High value, for example, jewelries, right? So all these are using specific identification.
I have another question.
Yes.
So since we sold only 1 unit and the cost of goods was sold, which is on March 1st, how come under the balance we have 2?
How much you have initially?
Initially, I have only 2 for. I have 3 for 1,002, and I
Okay.
have 2 for 1,000.
Okay, so now on March 1st, you sold 1 unit of 1,002.
Oh, okay.
Right? So because you sold, so it means that the balance now only 2 units. Huh?
Oh, okay. I got it now. Okay. I think my brain is like a bit.
It's okay. It's a very tiring already, but it's okay. We go slowly, yeah.
Thank you.
It's good that you ask question, because maybe others are not aware of that. Okay, so we move next. So when you have the specific identification, when you make sales, remember that you are going to receive cash of 1,800, because why you say 1,008? Because it was sold for 1,800. Yeah, the information provided. So you sold for 1,800 and credit your sales 1,008, but the cost of the goods that you sold is not 1,008. The cost is only 1,200. Right? So you debit your COGS 1,002 and credit your inventory. So that will be your journal entries for the first item. Right? So under this one is specific identification. I do not want to go into average method, all right, yet, right, because later once you understand better, all right, you can go back to this slide, right, the average cost method. Let's go into what we call first in, first out method, all right. So what it means is that first in, first out, it means that whatever that you have balances in your accounts, all right, when you make sales, you're going to take from the first balances, right? That's why it's called first in, first out. First, all right, means that, do you understand what does it mean by first in, first out? It means that your first inventory that comes into your business will be the first that goes out from the business when there is a sales. Is that understood? Okay, let's look at the example here. All right, on January 5th, you have a balance of 2 units and each one costs you 1,000. So on January 5th, you have balance of 2 units. Each one costs you 1,000. So total balance you have is 2,000. Is that clear? On February 5th, you purchase another 3 units and each unit costs you 1,200. So the total purchases is 3,600. So as of February 5th, all right, you have 2 units at 1,000 each and 3 units at 1,200 each. Understand?
Yes, doctor.
Yes, doctor.
So when it comes to March 1st, all right, you sell one unit for 1,800, but using a first in, first out method, you have to record your goods sold based on your first in, first out. So it means that looking at your balances, which one is the first in? The cost 1,000 or 1,200?
1,000.
1,000 is the first in. So because that is the first in, that is also the first out. So when you make sales under first in, first out method, you're going to take the cost, which is the first cost. So in this case, you have 1,000, you have 2 units at 1,000, so you sell that 1 unit, right? 1,000 at 1,000, 1 unit at 1,000, so that is sold. So the balance that you have now is 1 unit at 1,000 and 3 units at 1,200. So total closing stock that you have is 4,600. Right? So this is what we call first in, first out. In terms of the entries, all right, this one is what? Okay, hold on. Okay. Do you understand first in, first out? Right, you look at your total, just before the sales, look at the balances. First in, first out means that you're going to take your stock, from your goods sold, the cost will be from the first in that you have, right? The earlier balances, right? Because the other method that we know is that what we call last in, first out, right? Last in, first out, we are looking at when you make sale, the cost that you are going to take is the one that is the latest, all right? Last in, so means that if you have 2 units at 1,000, on February 5th, you have 2 units at 1,000 that you first purchased, and then you purchase another 3 units at 1,002. So which one is the last in? Which cost is the last in? The 1,000 or 1,200?
1,200.
1,200. But the law says that under this method, what is last in will be the first one out. So when you make sale of 1 unit, all right, using last in, first out, so you're going to take from the 1,200 cost. So you're going to take the cost of goods sold is based on the 1,200, not on the 1,000. Why? Because last in, first out, you're going to take from the last in to be the first out and the cost of goods sold. Can you see the difference between first in and first out? First in,
Yes.
first out of FIFO, and here is last in, first out under LIFO. Right? So then, of course, you see that under LIFO, the closing stock is 4,600. But under FIFO, the closing stock is 4,600. There's a difference there, right? Here, the cost of goods sold is 1,000. Closing stock is 4,600. Under LIFO, your cost of goods sold is 1,200 and your closing stock is 4,400. So it makes a difference in terms of the value of your COGS and the value of your closing stock, depending on the method that you employ. Right? So this one is looking at, so if we look into the specific identification, first in, first out, and the average cost. So the average cost is actually looking at the average, right? So I did not show that so because I do not want you to get confused. So for example here, all right, the average cost, you have the balance, right? Initially it was 2 units at 1,000 and then 3 units at 1,200. So total units that you have is 5 units and the total cost is now you have 5,600. So when you make sale of 1 unit, you want to look at the average cost of the unit. So average cost is that you know that you have the total balance of 5,600. How many units? 5 units. So the average cost per unit is 1,120. So that 1,120 is your cost of goods sold. Yeah, so this is the method that you use average cost. So again, for average, the total dollar divided by the number of units, you will get the average cost per unit. And the balance now, because initially you have 5 units, then you sold 1 unit, balance 4 units now, the cost is 1120. So you use the average cost for the closing. So that's the 4 methods: specific identification, average cost method, first in first out FIFO, last in first out LIFO. So this is what we call the accounting inventory valuation methods. All right, because you want to value your cost of goods sold and your closing inventory, right? So the principle of consistency says that for a company that adopted an accounting method, or for example, whether you adopt average or specific or FIFO or LIFO, you must follow that method consistently. All right, you cannot switch from one method to another. Yeah, if you want to switch, you can, but you have to put that in the notes to the accounts, and you have to you must get approval from the board of directors first when you want to change your accounting method. It's not simply just, right? So have you heard of just-in-time inventories? So this is another method, all right, that where you will order your inventories using a just-in-time, right? So when you do your management accounting, you will go into this more detail, right? When you do a physical stock take, we mentioned about your shrinkage. So when there's a shrinkage, you debit your cost of goods sold and credit your inventory, right? Okay. Now, this is more important also when we talk about LCM, which is what we call lower of cost or market, right? So when your stock is obsolete, all right, you're going to reduce the value of the inventory. So obsolete here, it could be because of the shrinkage, right? So when there's a shrinkage or obsolete, you're going to debit your COGS and credit your inventory account. However, another issue is that we have the lower of cost or the market value, right? So remember that you have whatever that you have recorded, all these is at cost. What is the cost when you purchase the inventory? But at the same time, all right, the inventory may also have a market value, or what we call a replacement cost value, right? A market value. So you have to compare the cost and the market value. Why? Because you have to record your inventory, all right, whichever is the lower. So you have to compare between the cost of your inventory and the market value of your inventory. Whichever lower, then you have to do, you have to record that in your financial statements, right? So if the cost is lower, that is okay, means that you don't have to do any adjustment. But if you see that the market value is lower than your cost value, then you have to use your market value. So for that, you have to do some adjustment. So let's say, for example, you purchase, let's say I say that your inventory, when you first purchase, the cost is 1,000, right? By middle of the year, after 6 months, the market value of your inventory now becomes 600. So when you want to report your financial statement, you must record the lower between the cost and the market value. So if you want to record in the financial statement, which value that must appear in your financial statement? The cost or the market value?
Market value.
Market value. Why? Because the market value in this case is lower than the cost, right? So you have to take the lower. So for that, you have to adjust your inventory. So if I say that, for example, here you have LCM and write downs, okay? So let's look at this. This is your FIFO cost and this one is your market value, right? So you have two types of item. You have ski equipment, you have the downhill skis and the cross-country ski. So this is the type of equipment, right? Ski is the one that you use when there's a winter, right? When you play when there's a snow, you play ski. So these are ski equipment. All right, look at the downhill skis. The cost is 16,000 or the market value is 18,000. Right? But for the cross-country skis, right, the cost is 4,000, but the market value is 3,000. Right? So this is individual. But the total ski equipment, you have total here is 20,000 and total here is 21,000. Right? So there's a difference here. Individually, if you look at downhill ski, you have to report cost or the market. Which one should you record?
Market.
Price.
Which one you should record? You have to record the lower.
The lowest one, yeah, yeah.
Cost or market value?
FIFO cost.
Cost, yeah. So for downhill ski, 16,000 is lower, so you should record the 16,000. The cross-country skis, the market value is lower, so you should record the 3,000. But in totality, you see that, right? In totality, the cost is lower than the market value. Right, so what you want to record? You want to record the lower, which is the cost of 20,000. All right, but if you look at here, another accessories, we have the ski boots and ski jackets. Similarly, ski boots, you have the market value is lower, and ski jackets market value is also lower. Yeah, total, but the total also you have to record the market value. But in terms of the totality of the inventory, right, ski equipment plus your ski accessories, total is cost is 29,000, but the market value is 28,500. So how are you going to apply the LCM? Yeah. So for example here, for individual items, you're going to record the lower, which is the cost, right? For individual items key here, you're going to record the 3,000. But if you're looking at the inventory category, you're going to record 20,000. Yeah. Similarly here, you're going to record individually. If ski boots, you're going to record 1,005. Ski jacket, you're going to record 6,000. But total here, you're going to record the 7,500. And here, all right, looking at this, you see that how much is your value now? Now is 26,500. And here is 27,500. So what is your total inventory? Total inventory, which one now? So they say that, all right, because of this, you have to record the lower of, right? So why is it that you have 28,500? There takes that total inventory. For example, here total inventory, you're going to record the 28,500 because that is the lower, right? So how are you going to decide? Or you have decided, but how are you going to do recording of these adjustment? If you take the cost, so there's no problem because whatever that you have in your accounting is always at cost. But when you have to take the market value, all right, then you have to do adjustment because the market value in this case is lower. So you have to do some adjustment. So how is that adjustment? It's not shown here. Oh, dia tak show lah. Okay. All right. So what you have to understand here is that depending on whether you have to identify individual items or in this case inventory category, or you want to look into the total inventory. Wherever it is, it has to be the lower of between your cost and your market value. That's all. Yeah. So given cost of the inventory and the market value, then you have to take the lower. Yeah. All right, we have gone through this periodic inventory system under recording, right? Inventory, so we have this. Right. International Accounting Standard prohibit the use of LIFO, right? So we have just now FIFO and LIFO. So most of companies normally use FIFO because why? The International Accounting Standard prohibit, all right, the use of LIFO. But you must know what a LIFO is because you have to make a comparison between FIFO and LIFO. Right? Don't worry about this, right? Gross profit. Okay, this one is too detailed. I do not want you to go into this. It will make you more confused. All right. So what we have covered so far is that we are looking into the inventory valuation method. How are you going to value your inventory, right? Using whether it's a specific identification. Why valuation of what? Valuation of your cost of goods sold and your inventory. Right, so specific identification means that they are using actual cost of the unit sold, right? But average cost, you're going to use the number of units sold times the average unit cost for your cost of goods sold, right? And then first in, first out, cost of earliest purchases will be your cost of goods sold, and cost of the most recent will be your closing stock. So, but LIFO is different because cost of most recently purchased will be cost of goods sold, and your inventory will be cost of your earliest purchases. Right. So you have to understand. Right. Under normal economic condition, right, price of items normally increases or decreases over time.
Increase.
Yeah, price always increases over time, right? Under normal circumstances, we have the inflation. Yeah, so price increases. So when you say that when you use FIFO, right, so you are going to use your COGS as the first item that you purchase as your cost of goods sold, right? So cost of earliest purchase on hand is your cost of goods sold. And your inventory, your closing inventory will be cost of the most recently purchased. All right, so it means that the FIFO will give you a better representation of the economic condition. Means that when you sell the old units first, and your closing stock represent your most recent purchases. But if LIFO is the other way around, because you will sell the most recent purchase, and your closing stock will tell you, all right, the cost of inventory based on the old units. Yeah, so that's why LIFO is not acceptable by the standards. Yeah. It may overstate income during period of rising prices, may increase income tax due. Yeah. So the implication of this, all right, the comments here, it says that if you use FIFO, cost of goods sold is based on older cost and the closing stock is valued at the current cost. However, the FIFO may overstate income during periods of rising prices, right? It may increase income tax due. So that's why some company, when they want to pay tax, they will move to LIFO, right? Because LIFO will give you a lower gross profit. Yeah, because lower gross profit means that lower income, lower taxes. All right. So now it's already 10 o'clock. I don't think I should continue further. I think that everyone is very tired. I want you to do, all right, if I were to look into where's my, yeah. Okay, let's look into your, can you see your Google Classroom now?
Yes, ma'am.
Yes.
Right. So let's go into your chapter 8. Chapter 8. Where's chapter 8? Chapter 8. Right? So under chapter 8, what I have here is, alright, what is your, how to compute COGS under FIFO, closing stock, 12 units, specific average method, right? Not much, right? You can access your PowerPoint under PowerPoint's FA PowerPoint's presentation. So look into your chapter 8 here, and then there is no chapter 8. I don't have any chapter 8. I have the lecture there.
It's 10 o'clock.
Let me see if I have any tutorial on chapter 8. Yeah. If I have tutorial on chapter 8, you can do some. Chapter 7 on inventories. Yes, I have it there. I have tutorial on inventories. Okay. Okay, this is good. All right. Okay, I want you to do this first. All right. And I want you to submit me this tutorial as your group exercise. Right? I want you to discuss, because I want you to learn this topic with your friends and do this as your group exercise. You like the idea?
I think it's good. Yeah, at least we understand how it goes.
You want to do it now?
Yeah, I guess it should be fine.
Mm.
Or you want to keep? I'm not sure, but we can discuss with the rest if they want to do it now or they want to do it as in like we get back to you like last time, like how last time we did it.
Yeah, I think that is because it's already 10 o'clock, so everyone is already tired. I think that you should give yourself some time to review this topic, right? And then you can do some exercises here. And then only you come and discuss further with your group mate, right?
Correct.
So once you have understand, you have to study first, all right? You have to review this topic first, because if I were to do this question with you now, all right, I don't think you can actually think wisely, right? Because your mental is very tired already with all these new topics, yeah.
Madam, sorry.
Yes.
Sorry, madam. You have uploaded chapter 8 already, because I cannot find.
This one. What are you looking at?
Chapter 8, the one that you said.
I am now.
I only see chapter 6, the latest one.
Yeah. I'm posting it now.
Oh, okay, madam.
Yeah, I'm posting it now. But I'll show you just now.
Ma'am, I have a question. Even do we have classes only up to chapters week 6? As I was watching this course outline.
Yeah, enough, too much.
But what about after week 6?
Chapter?
I was just watching this course outline. There was only classes up to week 6.